Hello, welcome to Cryptonomy. Today we're going to be discussing why the clock is ticking for Bitcoin and why we might be heading lower. We're going to be discussing volume, liquidity, previous patterns that have been broken, like the rising wedge, previous support lines that is being retested right now and being flipped to resistance, and more. So if you enjoy this content, do try and watch this video. My name is Mo. I'm a computer and data scientist. I've been a crypto investor for the past 6 years, and I was able to turn a small crypto portfolio into 6 figures this cycle. So if you would like to learn some of the strategies that I used along the way and some of the mistakes I've done, then try and watch this video and like and subscribe. Yeah, the first thing we're going to be discussing is the importance of the 3-day SMA, comparing to what most people use, which is the 1-week SMA. Now, for a speculator in the market, it is important to find an edge, right? So that we can be profitable. If we are ahead of other people, it's a zero-sum game, and then we can make money. If we're not, then they do make money, right? And I try to find my edge in every way possible. And I'll explain why I like to use the 3-day SMA. So the 1 week is 7 days, right? 7 days. But the 3-day is 3 days. But if you multiply by 2, that equals to 6 days. That's the whole idea, okay? So by using the 3-day SMA, I am 1 day ahead of people who use the 1 week SMA. For example, the blue line corresponds to the 100-week SMA. But the green line right here is the 200 3-day SMA. All right, so every week I'm 1 day ahead, and in total that would be 100 days. But you'll be like, all right, is that a valid point? Like, they are different SMAs and they probably have different characteristics and whatnot. And does it even work? I think yeah. Because if you go retest back in history, you will see that the 3-day SMA is actually an early signal for the breaking of the 100-week SMA, either to the downside or the upside. Let me give you a small example to illustrate. Okay, so if we just go back to the previous bear market, right here, the 2021 November starting bear market. The first thing we notice is that we have found support not at the 100-week SMA, but rather the 200 3-day SMA. All right, let's change that color to maybe orange. That would be nice. Yep, sure. It's not orange, is it? That would be funny if it's not. Yep, it's not. Let's do that. Let's do that. Okay, perfect. So what we found here is the support, and after breaking the 3-day SMA, we finally just accelerated down the 100-week SMA. Is it a valid point here? Possibly. Did that provide an early signal? Yes. There was 2 fake outs, but eventually, once we performed some 3-day closes, that was the signal that we're heading lower. You can see that even on the upside. So if we go to the upside here, right, that's the 3-day, 200 3-day, and that's the 101 week. So we actually found major resistance, not on the 100 week, but rather the 200 3-day. You can see we were battling here. We went up, we tried to break it, but we just failed. We were under it, and then when we finally broke it, we just exploded right to the upside. You didn't even have to test the 100-week SMA. We just exploded right through it. Similar to the downside. Is the point getting more convincing? Possibly. Let's go back even further in history. All right. So if you go look at the 2017 December bear market, you see something very similar playing out. The resistance, the support was actually a 200 3-day SMA. After breaking that support, we just accelerated below the 100-week SMA. And when you break the 100-week SMA, that actually corresponds to either sometimes the second leg down, or in our case, that would correspond to the actually breaking of the short-term relief rally and finding the bottom of the first leg down. So I hope that just cleared that point. We're not going to discuss too much on it, but I want to discuss the 4 phases that actually happen in a bear market, which we usually describe on this channel, right? And you will find it very intriguing and helpful, hopefully. So we can separate the bear market into 4 phases. The first leg down, which is that phase right here, okay? And then we get the second phase, which is the consolidation period, okay, following the first leg down. After that, we actually form the second leg down of the bear market. And note that the first leg down, bottom, forms some kind of support, right? It forms a support line for the consolidation period that will come after. Damn it. Like that, right? So that's pretty interesting. And after that, usually comes the final phase of the bear market, which is the accumulation zone right here. That can be the accumulation zone where you want to actually accumulate most of your Bitcoins, and that's the best price you can get on it. Okay, that's one cycle, but does it happen more often? Because it has to happen more often for us to actually say that that's a valid assumption of the bear market cycle. That's a valid way to look at the bear market cycle. So let's go and look at previous bear markets. We're going to use one more example here. The first leg down, that right there, that first leg down bottom formed the kind of the support line for the consolidation phase. The consolidation phase is this period right here, and breaking the consolidation phase actually forms the second leg down, which is down there. And after that is the accumulation zone. How beautiful. It all fits perfectly. Okay. So most people think we are rather in that period here. Valid point. I see why many assumptions are coming through that way. Isn't there some similarities? Yes. But I would argue that we're not yet there. Okay. The first argument is that we usually find December strength, and that December strength is right here, for example, in that period, right here. And for that started on 3rd of December and ended around 27th of December. So usually we break it at the end of December. We found something very similar to the previous cycle too. Right here, we saw some strength in December, and that was not the bottom of the first leg down. This was just a short-term relief rally for the December period. Right now we're seeing something very similar. Very, very, very damn similar. But here it actually started earlier, in 21st of November. And you would argue that's because we topped earlier. That's why the short-term relief rally started earlier, right? So we topped around 18 to 20 days earlier. And therefore it would be a safe assumption to say that, yeah, we might be having everything a little bit earlier, and that's normal. Some of these periods, for example, the short-term relief rally maximum days that was spent was previous cycle, which was around 32 days if I recall. Right now, I think today is the 33rd day, right? And that's normal, because if you remember here, we've actually reached the top way earlier and before the halving, and this is why we had this elongated consolidation phase that actually was able to, push the cycle a little bit. That was, like around 4 to 6 months earlier of having the peak, reaching the previous peak, right? 6 months earlier than usual. And that's why we did have a 6 months consolidation period, and then we finally broke it in time. You see what I mean? We reached it right there, but we broke it in time. We just formed a big consolidation zone, and we just drew a funny face, didn't we? Anyway, we did reach it earlier, consolidation, we broke it in time. And therefore here we kind of ended earlier, we started this earlier, therefore I think we might be spending a little bit more time here, but not so much more time. So if we go and actually analyze the previous current moves, As we said, the previous one was 32 days. So if you go and analyze every single short-term relief rally that happened previously, as we discussed, this is just two of the examples here. One is 25 days and the other one is 32 days. And the first one, I think, around 18 days or 9 days. Then we've just reached, the maximum range of that. And I think the clock is ticking in that metric has already exceeded its range, and you can see that it's not a wide range, so we might extend by a few days to a week or something. I don't know. Nothing said in this video is financial advice. It's for education purposes only. Please, before making any major financial decisions or even minor ones, do your own research and also check other resources. But this is what the data says, right? So that's why I think the clock is ticking, based on that one metric. But there are other metrics we're going to be discussing as well. One of which we have touched on, which is the 3-day SMA. We've broken the 3-day SMA, and we are retesting it as resistance now. So it was support, now it's flipped as resistance, and as we have seen earlier in history, once you break that, the break of that is imminent. It's imminent, based on history. And the break here does not happen slowly. As we have seen, it happens quite rapidly and in a forceful way that just takes everybody by surprise. So that's what we need to keep in mind. Another thing I would like to discuss is actually the first leg down statistics, okay? So this is the first leg down. The first leg down, we have touched on it a little bit in explaining, and that's the first leg down here. And the top was here. Okay. So if you take the statistics of all the first leg downs, then you do get numbers that look as such. Okay. 77 days. Yeah, that moved a little bit before, but yeah, 77 days. Okay. And then if you take that one, right, similar thing, first leg down, support of the next consolidation phase. And if we go a little bit further, first leg down, support of the consolidation phase, and then you plot all that in a box that forms a range, and you take all the calculation of that, pinpoint it from here, so everything is calculated from here in terms of percentage drawdowns and time, right? That's the scale. Then you get a box as such. And it does make sense, because that means we would find support at around the 200-week SMA. I don't think we're going to be touching some of the lower ends of the percentages, because we're seeing diminishing drawdowns, right? Similar to how we see diminishing returns. Even the diminishing returns of this short-term relief rally, we usually go up to there. If you take, that's the minimum that we usually went. But here we just formed it here. And therefore, I think we're just gonna maybe even not inside the box. I'm not sure, but nobody knows. Nobody really has a crystal ball. But that's the target we're kind of leaning towards. That we should be heading toward that zone to some extent at that time period. Therefore, we come to our third reason why the clock is ticking. Because we should reach there maximum by 16 January of next year, based on historical findings, when you calculate everything from this peak, if we assume that's the peak. But of course, there should be some standard deviations applied. So we could not hit here. We could maybe go here. Maybe we could reach the bottom there or there. But nevertheless, this gives us an idea of what to expect. Not a predetermined, sure, get there zone now. It's just to guide our decision making. That's how we use historical data to guide where we're going. So yeah, that's the third reason why I think the clock is ticking. Another one, which is also interesting to see, is the decline in the buying pressure. So this short-term relief rally that we're seeing, the strength in December, is getting weaker. is getting weaker and weaker and weaker. And when you get that to that week, when you reach those levels, I think that could be a nice time to you know, prepare for the downtrend. Another thing, speaking of volume, which is, it's my favorite, this helped me a lot, even in the finding of the peak of the cycle. It has helped me tremendously. I'll probably not share this type of information, I'm sorry guys, later when the channel goes more higher. And you know, yeah, I'm gonna sound like a not nice man. Some things a trader has to keep for himself as an edge. But since this channel is small, I don't think anything I say right now is gonna affect my profits in any meaningful ways, and therefore I'm gonna share it. But please limit the exposure to which you show this to people. Please, 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 please. We take the VWAP, volume weighted something something, whatever the name is, and you take the quarter, okay, and you take the damn quarter, and I only look at the quarter. Okay, sometimes look at the month to actually determine when the quarter would happen, but all you need to really use this indicator for is see when the top and the bottom lines contract or clap. Clapping action. When they contract or clap, usually what that means is there's a regime shift or some kind of trend, something explosive that's going to happen. Or it sometimes means consolidation for longer. Okay? Here, when that clapped, one thing that Bitcoin likes to do when the VWAP claps is sometimes it likes to, confuse people. It would go up on the clap, and here I went long. I went all in when that happened. But then it went down. And I was like, oh no. With that volume right here, with that volume right here, with the VWAP doing its crazy thing, I sold everything here. I was fully exit. And that's because of the VWAP. Because I know VWAP, Bitcoin does that thing usually in periods. Bitcoin does this confusion thing in periods of VWAP, right? And the Bitcoin cycle was renewing its end and whatever, blah, 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 blah. It makes sense, right? Here it formed, we are heading for consolidation. Here, as you can see, it just keeps doing it. Whenever major movement you get, here it meant, upside. Here really didn't mean much, it's just a little trend shift. But here, you have to use that indicator with some prior knowledge or some direction that you predetermined before, and then that's when it helps you. That it doesn't tell you the direction, it tells you the timing, right? The direction is up to you. The VWAP just tells you it's time for something big. It's time for what? For something big. That's what it's time for. All right? That's what it's time for. Here, consolidation, consolidation. Here, this is what we did before. You see? This is where I got this from. I remember when they were about to release the ETF, right? The first trading day of the ETF, the big news, everybody was happy, everybody was excited, the VWAP clicked, we went up and we went down and we confused and then we went up. This is what I mean. Sometimes the VWAP tells you, oh, be careful. Something as big is happening, but sometimes there's some manipulation. Again, the VWAP got it right here. I think you get the point. Please use it with caution. Please don't tell it to anybody. And I hope it helps you. So what I'm waiting for here, why the clock is ticking, is because that's a big range. And the more expanded we get as such, the sooner the clap happens, okay? And right now we are expanding heavily and the period is pretty long. So this should clap anytime, or contract should clap anytime. And when it contracts, my personal bias is boom. Okay, my personal bias. But of course we could do boom, boom, or we could, for all I know, boom, right? Where's your bias? you apply to the indicator. So we discussed volume, we discussed VWIP, we've discussed why the 3-day could be very helpful for you and why you should maybe sometimes use it instead of the 1 week. Another thing I want to discuss before leaving you is, remember that megaphone trend line we have just, it was a big talk back then when people were like drawing lines like that. Yeah, we just retested it and we got rejected. Another sign why our bias is downside. Another one pattern that is important, the rising wedge. The rising wedge, statistically 60-70% of the time breaks down. All right, breaks down 60-70% of the time. That's statistics. You can check with ChatGPT or online, up to you. And usually we hit it 3 times. We've discussed this actually, and before we break, right, if you go check the breaking of the rising wedge, we said that 3 times retesting should mean break. Usually 4 times is higher certainty, 5 times is absolute certainty. Okay, that's from our research, right? So we discussed that. And also, funny enough, we did not only discuss when the timing could be happening. If you go check some of the earlier videos, we discussed this candle and why we could be forming some form of support here. Okay, so if you like some of these tricks and tips, and I hope some of the things I said here helped you, try and leave a like and comment, please. If you like more and comment more, I can make more videos and give you some more secrets and tips, and maybe subscribe too. That would be amazing. Thank you so much. So let's continue discussion. Here we also retested and rejected the rising wedge, which is a bullish sign. But one thing I'm actually, before we go all in on being short or whatever your strategy is, selling or buying or waiting for best place to buy Bitcoin, to confirm the downtrend of this rising wedge, you have to see some other things playing out, not just some retest and breaking. We need to see higher volume, higher red volume. Right now, that's empty. So the clock is ticking, but it hasn't ticked yet. Retest of the support, that we did that. Okay, usually I want to see 2 of these to be convinced. Or a continuation candle. A continuation candle could be something like a large red candle to the downside. That is 1.5 to 2x larger than the previous range candles. So if that's here, then we should minimum be somewhere around here, right? If we get a candle from here to here, that's a continuation candle that would tick that, and then we can confirm that we are more certain that we're going lower for longer. So yeah, one more thing, the fib channel, the ascending fib channel, that has also been tested as resistance. Getting 3 trend lines and 3 structures that has been retested as resistance as we speak. I hope you enjoyed this video, and I hope you learned something. I'll see you in the next one. Peace out.